Hey traders, welcome to a global macro update. So a lot has happened. The S&P has actually moved back up to its recent high of around 2890, let's say just under 2900. So definitely bulls are present in the market, but we're going to discuss why we are still bearish on the S&P and overall U.S. economy, and B, what we could potentially be seeing here for a structure that would be indicating a more bearish move. First off, I do just want to look at a previous stock market crash with Japan that they had in the late 90s. We can see right here, early 90s, and then the lost decade was from the early 90s until the early 2000s. But we can see this was the Japanese stock market crash, and there was a huge amount of speculation in the late 90s in Japan. Basically, monetary policy was to print lots of money. There was expansion in credit, similar to the United States. And it was in a pretty big asset bubble with real estate and equities. And this was basically the explosion, the bust of that huge boom in Japan. Now we can see the price action does look a little bit different for sure. If you have any idea of what we're looking for, we are looking for that 50% to 61.8% retracement level for a key level of supply. This is the current price action that we have within the S&P 500. We got a push to the downside. That's our first main push to the downside, indicating the bearish market. And then we're looking for the exhaustion move, the pullback, and then we are looking for the validation that there are bears in the market. Now, within Japan stock market, post the initial move to the downside, we got a ascending channel flag. You can call it whatever you like, but this is a bearish pattern to the downside and a continuation to make that next leg down. Now, what did we see? We saw a push to the downside to initiate the actual bear market continuation, but we got halted by a key level of support, previous level of resistance, previous level of support and resistance right here. So we can see that even though it initially popped, now obviously everything is hindsight looking back, but just looking at the actual structure of the price action, we can see that after the initial failure, there was a last little rally retesting the previous highs, and then we got a huge move to the downside. So looking at how this actually played out, we can see that we can still have a bearish bias even if we see a little bit of momentum back to the upside, because in previous economic situations that we've backtested in the past, this is somewhat common, and the most important place that we want to be looking to change our bias from a bearish bias to a bullish bias, in my opinion, is going to be the 61.8% fib level. If the price does go above this zone on the daily chart, I will have to change my bias. I've fully accepted that. But until it breaks this zone, as long as we're sticking within or below the supply zone, I'm going to be bearish. I'm going to have a bearish bias. In that said, let's discuss, first off, why we are looking bearish. Obviously due to the potential double top, but more importantly, the fundamentals that are going to drive the sell-off or the potential sell-off. Now, what is that going to look like? Well, for me, the most important thing is going to be the actual stats that are going to give some indication of the health of the economy. Right now, it's a lot of speculation. A lot of people don't really know how bad the overall health of the economy is. We have seen some numbers like the initial claims. If we look back at just pulling back the March data, looking at basically from 2019 and backwards, it's a pretty normal looking chart. We see these highs in the dot-com bust, which was right here. You see 1982, you see 1990 right there. So the gray lines are going to be recessions, but you see that it's pretty well a normal looking chart. If we incorporate the data from COVID, obviously the chart breaks. It literally breaks. You see the amount of people who are filing for unemployment absolutely destroy all other recessions that we've had in the past. Just looking at the number of people who are losing their jobs, it is unbelievable. Let's just zoom it up a little bit more. We see that initially 282 jumps up to, 3.3 jumps to 6.8 6.6, 5.2, 4.4. So yes, the amount of new people that are losing their jobs is slowly decreasing. There's still on a weekly basis 6.8 people who just lost their job. Another 6.6 who lost their job. 5.2. This is not accumulative. This is going to be brand new people who lost their job. So this number is going to be absolutely huge. This is the unemployment level that is on a monthly basis compared to the initial claims, which is on a weekly basis. So this is a lot more frequent in terms of how fast the numbers come up, but we haven't seen the April numbers for the unemployment level. So I think this week, looking at the economic calendar, will have a shock to the investors around the world of how severe COVID, and not just COVID, but COVID, oil, and the whole economic situation is for the globe as well, in particular the United States, because we're focusing on the equities within the United States. But I think this is what's going to drive the initiation of the next leg down. We haven't really seen the earnings, the statistics within the economy to show how bad the economy is getting hit from this lockdown, from the oil obviously going negative and seeing that huge capitulation. But let's just take a quick look of this week's economic calendar. We can see that the consumer confidence is going to be a big one. So we can see right here, the U.S Consumer Confidence Conference Board. Consumer confidence measures the level of consumer confidence and economic activity. It is a leading indicator as it can predict consumer spending, which plays a major role in the overall economic activity. A higher than expected reading should be taken as a positive bullish sign for USD, while a lower expected reading should be taken as a negative bearish sign. So what is going to be the forecast for this upcoming consumer confidence stat? They're predicting or forecasting 87.9, which in my opinion is still kind of high. If we're looking at the overall averages in the historic charts that we've seen, 87 is pretty healthy. We can see it's around 2016, 2015, but like anything, we can see the actual number go below the forecast, which would be pretty bearish. And these stats are slowly coming out as March is complete, so we will have to make sure that that we're keeping up with these stats here for the economy. Next thing we're going to look at, GDP. This is going to be a huge economic number for not just the United States, but for every country in the world, really, because every single country is suffering through this pandemic. So U.S. gross domestic product quarter over quarter. So GDP is a measure of annualized change in the inflation-adjusted value of all goods and services produced by an economy. It is the broadest measure of economic activity and the primary indicator of the economy's health. So usually the effect is if the actual is bigger than the forecast, it's good for the currency. And we can see this is the max. It doesn't show very far. But what they're forecasting, excuse me, is a negative 4% contraction in the gross domestic product, or GDP. And we can see at the worst of it in 2008 in the great financial crisis, we were sitting at -6, seemingly -7%, which obviously is a substantial amount quarter over quarter. So these types of statistics are going to be coming out that is going to provide investors around the world a more in-depth look of how much pain the economic turmoil is hitting the everyday individuals as well as the corporations and the overall economy in the United States. So yeah, I think this week's definitely going to be a pretty important one in terms of all the things coming out, all the important fundamental factors. We also see that pending home sales obviously is a good indicator. We see Fed interest rate decisions. They're forecasting that they're not going to do much with the interest rates sitting at 0.25%. That will have some impact of the market depending on the number. And then we see the initial job loss claims yet again. They're expecting that there's going to be obviously additional 3.5 million. We'll see how that goes. Canada has their GDP month over month economic stat as well. And then we have the ISM manufacturing PMI. What does that mean? So it is the Institute of Supply Management, which is the ISM, and then the PMI is the Purchasing Managers Index. So if you don't know what this is, quick refresher, what is a Purchasing Managers Index? Key takeaways, let's just quickly read this. The Purchasing Managers Index is an index of the prevailing direction of the economic trends in the manufacturing and service sector. It consists of a diffusion index that summarizes whether the market conditions as viewed as a purchasing manager are expanding, staying the same, or contracting. Key takeaways, really quickly, the PMI is a measure of the prevailing direction of economic trends in manufacturing. The PMI is based on a monthly survey of supply chain managers across 19 industries covering both upstream and downstream activity. The value movements of the PMI and its components can provide useful insights to business decision makers, market analysts, and investors, and is a leading indicator of overall economic activity in the United States. So this number is going to be an important one. We see that right now the forecast is 36.9 with the previous at 49.1. So if we're looking at the historic charts all the way dating back to 1970s, we can see that right now the forecast is around 36.9. So basically almost at the 2008-2009 low. So, you know, it's already priced in terms of the forecast and what people are expecting, but if it's lower than the forecast, it's going to be pretty bearish. And that's going to be the same for a lot of these economic statistics that are going to be coming out. Is there's going to be a lot of fear if the number is a lot lower than the actual forecasted number. So I think, you know, at this time, we know that the market is moving up. We see that the price is not really pushing down just yet. And I think that we will be able to hold this double top. If not, maybe a little bit trickle higher. But at the end of the day, I'm still bearish on the market. 100%. I do not think that the low is in. I think that we will have another move to the downside. So looking at what we started off with this simple structure of the ascending wedge, we broke to the downside. Let's just get our snip so we have a good understanding of what's happening right now. So we had a strong move to the downside. We held our key level of demand, which is around 2,700, just above 2,700. This is going to be the main level of demand that I'm wanting to see the price break for us to have a confirmation that there's going to be bears within the market. We did have this first confirmation, which was right here, this ascending support. Once that broke, I was definitely, I entered into a short, which I still have on right now. It has consolidated for a while here. I'm very, very comfortable with holding my short for as long as this consolidation continues because my bias is still bearish. So right now, after we broke this wedge right here, so once we broke this wedge, my bias went from an uptrend to now a consolidation. So now we take away these like so. So we put this for now, not being able to see it, and then we're going to put on a trend line that we have drawn in right here, and let's make that a little bit bigger just so you can see it. This is, in my opinion, the new trend line that we are currently holding. Let's just refine that a little bit more, just like so. So we got an expanding series of higher highs and higher lows. The only real reason I put this here is just because it's creating a series of higher lows. I just wanted to incorporate that. But at the end of the day, it's not a major zone that we're looking at. We're looking at the wedge that already broke. Let's just put that back in because that is the major zone. I just wanted to illustrate where we currently are within the market structure. So now that is a 4 hour. I'm going to go into the 1 hour and look at kind of the smaller time frames and what we can see right here. So let's zoom in to a point where we're able to really clearly see the 1 hour time frame. So a lot of people are saying, oh my God, we've bottomed because we've seen all this bullish activity. And yes, we have seen bullish activity. That's 100% correct. But that doesn't mean that we're in a bull market and the economy is completely healthy. Right now, in my view, there is a huge difference between what the stock market is doing and what the actual economy is doing. There is a decoupling from the equities market where stocks are going up because of the bounce and the declining health of the economy with the lockdown, with oil prices going so low. You know, those two things are major bearish factors within my bias as to why I'm looking to short the S&P. COVID, obviously, with the lockdown, coming into play. And then we do see the U.S. economy and key figureheads saying we're looking to open up the states, we're looking to open up some states. And yes, that is great news for humanity, but in terms of where we sit in terms of financial analysts and traders and people who try to capitalize on market moves, we've seen in China, we've seen in Singapore, we've seen in places that are a lot more aggressive fighting COVID, that we've seen resurfaces of second waves, third waves. You know, it's not a one and done, especially with how easygoing the United States have been with the lockdown in terms of not being super restricting. You know, there's riots of COVID, anti-COVID riots where there's a bunch of people grouped together and they're saying, screw it, this is a false flag and this is bullshit. And they're not treating it the same as more aggressive, authoritative states like China, where they're saying, you know, we're in complete lockdown. The citizens kind of don't really have a say compared to the United States, where they're a lot more, you know, freedom and liberty is more of a priority than kind of doing what the heads of the authoritative state want to do, kind of in a sense. So right now, you know, things are looking a little bit more optimistic within the U.S. economy because of the fact that there's potential for a reopening of the U.S. economy. But I think once the economic data hits and we start seeing the April month data, looking at all the different economic calendar statistics that we went over today, I do think that we will still have the sellers coming into the market, because right now there's a huge disconnection between the stock market and the actual health of the economy, in my personal view. So my bias is remaining exactly the same. We still see the price hold our recent high right here at around 28.90, let's say around there. And if we are able to hold that zone, we could see a nice squeeze that are going to come into here, where we see a series of higher lows connecting with a horizontal level of resistance, and we see the price continue to push to the upside. We see a nice squeeze. If we do push to the downside, breaking this key level of support, that could be a good opportunity where we're going to see some sellers really drive the price towards the downside. But you know, if we see a little poke to the upside, that's okay. Like I said before, the just above 61.8 zone is my area where I'm going to have to change my bias. But as long as it's sticking below this main level of supply, I'm very, very comfortable with holding my short, holding my bias, because right now, in my view, we're in a consolidation sideways within a key level of supply, and I'm not going to change my bias until I see a strong break invalidating my thesis. But right now, this is basically what I see as a consolidation sideways, where we got a key level of resistance at around, let's say, 2,900, right around here, key level of resistance or supply, and we have the key level of demand at around 2,740. So we can draw an ascending zone there, but the main level of demand is going to be at 2,740, and the main level of supply is going to be, let's say, 2,900-ish. So that's basically how I view the markets. Let's go into the smaller time frames just to discuss what we could potentially see for some quick day trade. But at the end of the day, we are trying to capture that bigger move that is potentially going to occur in the markets. So let's quickly go and jump into the 15-minute chart and just draw in this small ascending trend line that we currently see within the market right here. So looking back at the 1 hour after drawing that, what we could see is a high forming at the 29 or 28.75 zone right here as a key level of resistance. And then ideally, we'd like to see the dump back towards the downside, kind of like we saw here, where we saw the resistance get tested multiple times, and then we saw a dump to the downside testing the demand zone. So ideally, I think we could see something like that appear again, especially with the economic data coming in from this week and potentially next week here. I haven't really looked at next week's data, but definitely this week has a lot of stuff that are going to be coming into play, and probably going to be giving more information as to how the health of the U.S. economy is. So that is the completion of the SPX chart. I'm going to quickly go over the DXY, which is the U.S. dollar index. Not really going to be going over any more historic charts from Japan, because we've already talked about this potential structure occurring, and we don't want to get kind of blown away by this fake little push to the upside. We want to have our bias. We want to have our conviction because we've back tested over and over and over. The stats are there. We're just needing a catalyst to push the market down to start the momentum. All right, so we talked about the daily, we talked about the 4-hour, really going in all the way to the 15-minute. Let's quickly look at this DXY, which is the US dollar index. This is basically going to be the strength of the US dollar. Now we see we did break the squeeze here, but we're holding this consolidation sideways. We are making a series of higher highs. We can see very clearly right here, but we did break down from our support that was right here. So it does actually potentially look like we could see another little fall here depending on how far we move. But right now I view the market as a consolidation. It did look favorable, especially when we broke the $100 mark and held above it. But right now it does look like we are kind of consolidating sideways. We broke the support, but at the end of the day, I still see the market going sideways like this. So this is the way I'm viewing the market still, is we're seeing, in my opinion, a consolidation, and we can still see a push up due to a potential liquidity event that would occur if we start to see the market absolutely dump due to some fundamental factors of the job numbers being really poor. The overall economic health of the United States is getting shown to be weaker than a lot of people expect, and that's obviously very bearish for the U.S. Stock market. So we'll see where it goes. We're not really trading the US dollar index, but we are looking to see how the currency is holding up, because this was a huge push to the upside. If we're seeing a lot of people flood into the US dollar, that's going to be weakening for basically, looking at every single commodity that is with US dollar. If one person is selling, let's say gold, silver, coffee, they're buying the US dollar. So if the US dollar is very strong, we could see another sell-off because people are fleeing to what they think is a safe haven asset. And it definitely has been a safe haven asset so far within this recession. But in my view, the recession is still very early in the process, for sure. In my opinion, it is not even close to the end of this recession. We can see that this lockdown is absolutely detrimental. Talk about it with, or listen to any economist that has been in the markets for 3-4 decades. They're going to tell you that this is the biggest event of their lifetime, and they've lived through 08, 01. Depending on how old they are, they lived through recessions in the early 90s, and they've lived through a lot. And this is, in my opinion, like theirs, the biggest shock economically for almost centuries, really, decades for sure, since 1929, some people are kind of comparing it to. So yeah, if we are going to get something like that, there's going to be some major deflation before inflation, and that's what we're banking on for our short for the SPX. If we get significant inflation right away and we just skip the deflation, yes, the stock market will continue to go up, because it's not like the value of the stocks is appreciating a lot and going up a lot. It's just the value of the dollar is going down so fast that the measurement of dollars to whatever you're valuing is getting skewed by the debasement of whatever you're comparing the stock to, which is the US dollar. So you got to look at it in a sense of not just the value of the company, but the value of the US dollar. And right now, I don't see any inflation coming in, because we're looking at the CPI numbers, consumer price index numbers, which is going to give you a good indication of inflation. And not just that, just looking at it objectively from a simple economic standpoint, we can see that the velocity of money is going to absolutely plummet due to this lockdown. Even if it does open up a little bit, we've seen in China, we've seen in Singapore that the economics doesn't go back to 100% right after people start opening up the economy. Restaurants are still having to go through social distancing. They can't open up fully. People are still psychologically, financially hurt from the lockdown. They have less money to spend. They're going to tighten their wallets and save for a potential next wave. They're not going to be good consumers. They're not going to be going back to normal habits and going on trips and going and doing everything else like they used to. They're going to be more hesitant because of the situation that went down with a very long-term lockdown that China's seen, that the U.S. seen. I don't think it'll go back to normal economic activity. And that is what we're basing our thesis on. We see countries over on the east already have their second wave after very, very aggressive measures to try to curb the rate of spread, which they did, but you're seeing resurgences. It's not as easy as a one and done wave. And, with how kind of, not unprofessional, but with how different the United States has treated this compared to China, Singapore, and different states that have been able to handle it better, I just think that there's definitely going to be a second or third wave within the U.S. economy, which would obviously be very bearish for the stock market. So to sum it up, yes, we're still bearish. Yes, we still have our short on. We're being very patient because we know that these things have occurred before. Fake last little bull runs, retesting the highs. We don't need to be worried. We have a conviction in our bias because we've done our homework, we've done our due diligence, we've looked at previous price action in different time frames, in different economies, looking at Japan and their asset bubble, looking at 1929 and that bubble that burst. These 50% pullbacks are very, very common, and we got to have conviction. We got to be able to stay on course with our bias, because it's very easy to change your bias if you've seen it bounce this aggressively. This is a significant bounce to the upside, but at the end of the day, how in the world can something that looks like this have a only 30% drop? It just does not make sense to me. How in the world is that possible? I don't think it is. And, looking at how many people have lost their jobs and just the simple fundamental factors. Another thing that coming into play, just something a little bit random, but still pertaining to why we're bearish, is way less companies are going to be able to implement share buybacks because of the lack of revenues that they are able to produce due to COVID, due to oil collapsing, and everything else that's happening right now. There are companies that are doing very favorably. Amazon hit all-time highs. Amazon's doing fantastic. Other companies like Netflix or Zoom, they're doing fantastic, but those are a few select companies, and the majority of the economy is very bearish, extremely. And yes, there are a few companies that are, I guess you could say, benefiting from this situation. But at the end of the day, those small companies are not going to offset, not small, but those select companies are not going to offset the economic damage from this event, in my view. So that's why I'm still bearish. That's why I'm still not long. That's why I'm still looking for shorts in the market within the S&P 500. So I hope that you were able to get something from this video. I know that it's definitely been a long road to be patient and to try to basically capture this really, really solid opportunity for a short. And it's really easy to say, oh, we're bearish, we're bullish, we're bearish, we're bullish. But since the move down, since that P1 move for people who've been following us, we've been very, very dependable in a sense of the consistency of our message. We're not saying it's bullish one day and bearish the other day. We're giving thoughtful analysis and reasons as to why we think the market will either go up or down. And we've been very consistent with our message. So for anyone who has any questions about why we're still bearish, I hope I was able to provide enough evidence as to why we think the market will still go down. Now, it's not like we're never going to think that the market will go up, because we've seen in previous times. Let's just quickly look at 1987, which if we zoom all the way out, this is 1987 right here. This is the flash crash of 87, October, and it just recovered pretty well right after the huge move. So if we go from, body wick to body wick, we can see it blew right past the 618, and once it did, it continued going up. So it's not like these massive dumps to the downside every single time will get a continuation that's going to form these lower lows and lower highs that's going to be similar to what we see right here. But in terms of the severity of the economic impacts that oil and COVID is inflicting on the U.S. economy, I do think it's way worse than 87 and 2001 and 2008. Look at the freaking numbers. It's unbelievable. Once we see this number, that I think will show you the severity of the current economic situation, because we've seen 2008 was absolutely unbelievable. If we're seeing this chart look similar to the initial claims, you know, how in the world can there can be confidence in the stock market? It just doesn't make sense. And I'm all right with being wrong, but in terms of like simple economics and understanding how much of an impact this has for the everyday citizen, I just can't imagine it going back up. You know, I'll say when I'm wrong. I've given my location or price range where I have to change my bias, but at this point in time, I'm very comfortable with holding on to my short bias and holding on to my short trade because of the conviction I have. So thank you very much for watching. If you do have any questions, drop them in the comment section below. It does look like we are seeing a little bit of move down here. We'll see where it goes, but that was the video for today. We really hope you enjoyed. We're not posting videos every single day just because of the fact that, you know, there's not a whole lot of stuff we can talk about because we are looking at the macro view. We're not looking on the 15-minute chart all the time and just trading these small moves. We're looking at the daily chart, looking for a 30%, 50% decimation of the entire S&P. That's a huge move. We're not looking for a quick scalp. We're looking for something like in 2008 where we saw an absolute decimation of market cap. Like we're seeing massive pushes to the downside, 30%, 35%, 50%. That is the type of move we're looking to capture. So we don't mind waiting. It takes a long time. It's not going to be instant. But the payoff for being patient will be worth it if it does come into fruition, because a risk reward in that situation would be fantastic, and it's going to be a good payoff with the short fees and all this stuff, all the patience, and it will be worth it if it does basically the same thing that it did in every single other recession that we've backtested that has the same economic impact or similar, basically. So not much more to say. I know we've been a little bit repetitive with our message, but in my opinion, that's actually a good thing, because then we're just being very consistent with our message, which in my opinion is very important. So thank you very much for watching. We don't really have much else to add for today's video. I will be keeping a close eye on the economic calendar, looking at the data that's coming in to actually show the health of the economy, because right now it's a guess. People might think it's priced in, but the data that's going to be presented is going to provide further evidence as to how impacted the economy is. So that is the video. Hopefully you enjoyed it. If you thought that it was useful, entertaining, educational, it'd be great if you would subscribe to our channel so you can get more videos like this. We're active on our Discord as well, so if you're looking for more of a one-on-one communication with our team, definitely join our Discord, and we really hope you have a good day. Like always, I just want to end it off saying this is not financial advice. This is our plan of how we're going to potentially capture this massive short opportunity. This is sort of like the Big Short round 2 in terms of the severity, the potential profit, but also the devastation for the economy in a negative standpoint. But, you know, as a trader, it provides an opportunity. So thank you very much for watching. We really hope you enjoyed it. And until next time, have a good one.